By the end of this video, you're gonna have a full outline of all of the technical analysis concepts and applications that I've gathered over 8 years of full-time trading to be able to find opportunities in the market, do my analysis as a full-time day trader. So if you're brand new to trading or you have experience, this is going to be a showcase of exactly how I navigate the market. So I'm gonna show you, number one, the basics of reading charts. We're gonna go into analyzing trends, support, and resistance. Then I'm gonna show you market structure as well as patterns that can help us predict areas on charts, as well as all the smart money concepts and indicators that I use to enhance my technical analysis, make me more precise, and all of this is what I use on a daily basis to find the trade opportunities that allow me to be a full-time trader. At the very end, we're going to tie everything together, and I'm going to use everything that I've showed you on several examples so you can actually take what you're learning today and apply it to your own trading. So let's get into our first concept. All right, so the first thing that I want to cover is the basics of reading charts. Now right here I have a chart of Ethereum pulled up, but I think what's really important to understand, whether you're trading already or you're not, is that what we're seeing here is a visualization of mass human psychology, whether it's through algorithmic trading or actual trading. But nonetheless, what we're looking at is collective decision making as to whether something is valued at a higher or a lower level. And what our job is as traders is to figure out areas of the market doing all sorts of analysis, say for example here, where the market has a higher probability of moving in one direction versus the other, where we can enter into the market, control our risk, and hopefully be able to make multiples of what we're risking through doing this analysis to then be able to make profit over time. And there's infinite ways to be able to do this type of analysis. I've been doing this for 8 years. I'm going to basically break down exactly how I do this. But what we first need to understand is how we're actually looking at this data on a chart. So you can see right here, we have a series of candlesticks. And these candlesticks are showing us valuable pieces of information. So you can see we have bullish candlesticks and then we have bearish candlesticks. Okay, bullish is indicated by a green candle. On my chart, it is a white candle, but still giving the same information. Okay, which is basically telling us that this is the entire movement over whatever time period this is, whether it's 1 hour, 1 minute, doesn't matter. That's how much the candle was moving over that period of time. This is the high, this is the low. Considering this is a green candle, this is the opening price and this is the closing price. And this is going to give us all of that price information in one diagram. And the same is true over here with our bearish candle. We have our high, our low, the total movement that we saw over this time period. And then we have our open up top this time and our close lower, which is showing a net change over time, the same way we saw a net increase over time over here. Okay, and as traders, this is giving us not only information on the net movement, but also ways for us to tie into other things to be able to anticipate directional changes. All right, so we can look at candle structures for bullish, bearish, and then neutral changes in direction. Now, this is going to tie into everything else we're talking about, but I think it's important to understand generally why these shapes matter so you can identify them and then use them when you're doing your analysis. Okay, I don't lean on this too much, but I think it's important if you're looking at charts to understand the general concepts of why this makes sense. Okay, so we have bullish reversals and continuations, as well as bearish reversals and continuations, meaning if price is moving down in this direction, if we're getting a reversal indication, that's indicating the market could push up. Okay, if we're already moving in a bullish direction, this continuation pattern would indicate a drawback and then a continuation in that direction. And the same thing is true in the opposite direction. Okay, so if we look at a hammer candle, that means that price opened here, attempted to push lower, and then ended up closing higher, indicating that price attempted to make a lower push and is now reversing to the upside. Bullish engulfing candle, we have a bearish candle, an equal bottom open, and a positive thick body candle close, indicating a potential reversal to the upside. We have a morning star pattern, which includes this candle, which is called a doji candle. This is something that I do use in my trading often, where you can basically look at if we have a bearish thick body candle, our doji candle, and then a green bullish big body candle. This is indicating that price could continue making a move to the upside. We also have an inverse hammer where price opened here, attempted higher, and then still had a big wick but closed bullish. Tweezer bottom, where we had a bearish candle push, an open, a continuation of a push, and then a bullish candle close with no wick. This pattern I've never actually put a name to, but I do use this in my observation with my technical analysis. We have sort of this rounded bottom here with these wicks attempting to make lows, all with long bottom wicks but short top wicks, and this last candle here having a small body. And for a continuation pattern, we have bullish 3-line strike, which is 3 sequential green candles followed by a big bearish candle with small wicks on either side that has equal lows here, filling up that space to make a continuation to the upside. Okay, we also have a rising 3 method, big green candle followed by 3 bearish candles and an equal size bullish candle indicating continuation of that trend. Then we have a bullish mat hold, big bullish candle followed by 3 smaller bearish candles and a bullish candle that breaks over the previous high of this candle. But these are things you can start looking for on your trend analysis to be able to further your conviction combination of reversals or continuations with what I'm going to continue to show you. Okay, so as we make our way over to our chart, you can see all of these candles are showing us all of that net change information as well as the high and low information, which are going to make up trends. Okay, so you can see on TradingView here, I have my trend line tool. Also, this is TradingView. If you aren't already using it, there's a link in the description. It's a referral link of mine. You can use this. Quick tip, they have a 70% off the annual charge if you get it on Black Friday. So you can pay monthly and then you get it all for the year, and you're paying for the annual subscription 70% off. You can use the link in the description if you want to. Okay, and these candles are going to show us trend levels. So you can see as price is sort of developing, we have these invisible areas where price continues to bounce off of. Okay, so if I go ahead and draw my trend tool here along these lows, this can indicate to us as traders where it's generally a good idea to look for buys, where price has a higher probability of reversing in our direction. We can also look to see where these trends are actually being broken. You can see right here, right here. These are really, really important areas. Okay, but all this data is basically showing us a general direction in the form of trends. Okay, and there's a few key important things to understand about trends. So first, let's go over what actually makes a trend. Then we're going to get into trend breaks and retests and why those are important. And then I'm going to show you something called anticipatory channels. And this is something that I've used in my trading for a long time, and this can be really, really important. So this is going to be really cool. But an uptrend is truly identified by having a higher high, a higher low, followed by another higher high and another higher low. Okay, once price pushes over this area here, we have a full confirmation that we have a true uptrend. And now anytime we have a change in trend, we can now use that to be able to understand when we're potentially at the beginning of a new trend. And if we're looking to generally as traders play into the beginning of trends to ride them to the upside, this is really, really important information to know. And we're going to get more into that in just a second here. But before we do, I want to get into the next important thing, which is going to be trend breaks and retests. Okay, this is one of the most important golden goose eggs that I've found in trading that's been able to allow me to snipe precise entries. And I'm going to show you exactly what I'm talking about. Okay, so realistically, what I'm looking for when I'm taking trades is to find these invisible areas like I was talking about before. So you can see price is generally moving up over this time period. Okay, we also have these areas up here, but I want to focus on the big one, which is really this one. Okay, so if I drag my trend level from where price is starting to do what's called consolidation, so you can see we have little pokes through these areas, but where is the price the majority of the time bouncing off of? Okay, which you can see is here, here, off of this level, off of this level. If we continue to extend this out, okay, you'll notice a few things. Price tested, and then tested again in closer proximity. Notice without creating a high over here, and then actually broke this trend level with a big candle. And you'll notice as it came back to test the opposite side of that, from there, price continued to make its way down. And you'll notice additionally, when price actually circled around and retested this area, and this trend level here was the exact high before a massive move to the downside. So you're going to see how this ties into other analysis a little further into the video, but being able to judge where our overall trend is will allow us to be able to see, instead of having a higher low and then a higher high, we now have a new low underneath that established low, okay, which is identifying to me that we have the potential for a downtrend. Okay, and it's not going to always just be so perfect that it's going to go back and forth between these trends, but it is going to give us these key areas of opportunity where we can play into these reversals. And we can see examples of this happening everywhere. If I were to go over to this group of price action, I'm noticing lows, lows, lows. Okay, you can see price finally has a big sell-off, comes back up, and you can see that's exactly where price came up before then making a move to the downside, which is now giving us confirmation that we have a new downtrend. And you can basically just go through charts and get really, really good at this, and this is going to allow you to find these key areas. And the third thing when it comes to support and resistance, as well as identifying trends, is something that I call anticipatory channels. And basically we can use something called the parallel channel tool on TradingView. And basically what I'm looking for are big swings in price action. So we see big swing over here, we have our big swing over here, then we have our external big swing over here. And what this is going to allow me to do is basically, once I have 1, 2, 3 points of contact, it's going to set me up in conjunction with our other analysis to figure out where our next swing point can be, which we can use to also time entries on trades and potentially critical reversal points. So what we can do is take this parallel channel tool, find this high, go over to this high, click, and then go down and match to this lower level over here. Okay, and what that's going to do is give us a potential area for us to expect where price comes down to, where it could potentially have a response off of. Okay, so you'll see price comes down, makes its way with these big candles. You can see this external area is exactly where price ended up having its flip and then making an expansive move to the upside. This general area is where price ended up going to before having its reversal back down. You can't really just use this by itself, but once you start understanding the trends and the things I'm going to show you next, this is a really, really important tool to be able to find, honestly, with these really, really big swings, where they can reverse, which is going to put you in positions using other systematic technical analysis to keep your risk really, really tight and have open-ended to make 7, 8, 10x what you're risking on the trade. So let's make our way into section 3, which is going to be trend in market structure. And so what market structure is doing is really drilling into how trends are developed and what we consider to be trends and what are key outliers that we can use to identify specific points to time reversals and or continuations. I'm going to take this a layer deeper in a second here. We can go even further into analyzing these trends, but it's important to have this foundation first. So we went over the higher high, the higher lows being the determining factors for trends. But what we're really doing as traders when we're talking about these structures and describing them and doing analysis on them can be characterized by two main things. Okay, so once again, we have our higher high, our higher low, higher high, higher low, but this time we have unique identifiers, which are called break of structure and something called change of character. Break of structure is basically where you have a move right here, which is called an impulse wave, a downward move, which is called a corrective wave. And by the way, this can be done in either direction, whether it's up or down. And then we have another impulse wave where we're having a close higher than this previous high over here. That's creating something called a break of structure. So you'll notice we have a corrective phase followed by an impulse phase over this high, which is creating a break of structure. So as long as we continue to have these break of structures, what that's telling us about the trend is that even when price is pulling down, it's creating a higher low, which is showing us that the demand is still outweighing the supply, driving the price higher. And then it's also showing us the fact that once we have a higher high and a higher low, we can watch to see when price is going to fail to make a new break of structure. And once we have a higher low, a high that pushes and then fails to create a new break of structure, and then we have a close lower than that previous higher low, that's going to give us something called a change of character. So it's changing its overall character of the trend. This is an extremely important area when we're playing into reversals, understanding where we can get these change of characters. Okay, because once again, pairing this up with our general trend analysis where we were doing before, where say we're drawing our trend level on these lows, once we do get a break and then a retest like we saw before, we can use this confirmation of a change of character to make sure that we're not getting tricked every time we think that the market is going to reverse, and we're actually waiting for proper trend developments with market structure for these key areas to play into reversals. So we can even take this a step further when it comes to analyzing these trends, and that's through something called Elliott wave theory. Now this is going to tie into even the next section where I'm going to show you how we can even further fine tune this, and it's actually scary accurate how we can actually time these areas. I'm telling you, this is like incredible that the markets actually operate this way. So I'm going to show you that in a second. First, we have to understand how Elliott wave works. Now, Elliott wave is a psychological study as to why trends develop in these patterns with our break of structure levels and our change of characters. But now we're starting to use mass human psychology and tendencies of trends by studying a 1, 2, 3, 4, 5 wave pattern tendency, followed by what's called an ABC corrective tendency. There's a few key rules to understand about Elliott wave theory, and here's basically a crash course on it. The first rule is this wave 3 cannot be the shortest wave. It doesn't need to be the longest, but it cannot be the shortest. Ideally, if we're following all these rules, we can basically anticipate by counting these wave structures and doing process of elimination where we'll actually have the tops of trends. And you can understand if we can use process of elimination to determine whether or not it's likely that we'll have a top of a trend in conjunction with other indicators, this can be really, really helpful information for traders for us to be able to get those big expansive moves in our direction while maintaining our risk and keeping it really small. That's rule number 1, that 3 cannot be the shortest wave. Rule number 2 is wave 4 here cannot move down and consolidate below this high or low of 1 respectively, whether it's an up or down trend. And that is another rule of Elliott wave theory. Rule number 3 is we need something called rule of alternation. What the rule of alternation states, if wave 2 is simple, meaning that the price is kind of moving in a generally straight line before moving in the opposite direction, that wave 4 must be oppositely more complex, more drawn out. So price would look more something like this, and it looks more complex than simple. And this can be done in either direction. So if 2 is complex, 4 can be simple, but they have to alternate and they have to look separate. And I can even take it a step further when it comes to predicting where we're going to get these tops of 5s, as well as looking to enter on potential reversals on Elliott wave. Now, this is where it starts to get more into me being creative off of what actual Elliott wave is. And I could take it even a step further when it comes to predicting the top tops of fives here in trying to find trade opportunities using extra pieces of technical analysis. Now, what I'm going to introduce to you is something called Fibonacci. And Fibonacci is a sequence that is basically the code of nature. It's a naturally occurring. It's a sequence that seashells, facial symmetry, trees, all of nature follows, and so do trends in markets. And we can use this to our advantage. So we can use something called a regular fib retracement and a fib extension. So I'm going to start with fib extension and explain how I use this. And then when we do our example at the end where I'm tying all of this together, showing you how I do it, I'm going to be showing you how Fibonacci sort of plays into the whole market as a whole. Okay, so first to explain how this is sort of going to work, I think it's important to understand what a Fibonacci is. So I'm going to use my regular fib retracement, and I'm going to go over the Fibonacci values. Here's what a Fibonacci looks like. And you'll see this is going to give me a sequence all the way from 0 to 1 with 23.6, 38.2, 50, 61.8, which is the golden ratio for Fibonacci, and then 78.6 as a default. So what we're realistically using this for in trading is anticipating where we're going to get trends that push up, where price could potentially make a move down to, react off of these critical regression areas before making a move up higher. But this sequence basically gives us this 61.8 level, which is a really, really important number, and you're going to see why in a second. The next tool is something called a trend-based fib extension. What that's doing is allowing us to take a distance, which we'll call our unit of 1, and what I can do is click on my tool. I can start from this point here, go up to this point, creating my factor of 1 or my unit of 1, and then bring this indicator back down. And now we'll start to see multiples of that golden ratio, 160.18, 260.18, and so on. So what I'm doing is being able to read trends in this fashion. All right, so if we have our 5-wave structure here, so what I can do on an Elliott wave is consider this first impulse wave my factor of 1. So what I'll do from here is take my trend-based fib extension. I'm going to click from the base of this trend up to my high, my factor of 1, and then come back down to my base. I'm looking for a few things as far as my number 1 layer of confluence, but what I'm number 1 looking for is to see whether or not I can have 160.18, 260.18, or 360.18 having a potential wave 5 by using process of elimination of all the rules we just talked about to see if we're getting a response off of one of these multiples while our other rules are still aligned. Okay, this is something that happens a ton when I'm analyzing trends and can give us really, really precise entries, and I'm going to show you how. Okay, the second thing that I'm really looking for is to see if the high of 3 here is going to hit off of the underside of 160.18. If I can have a response off of here, a pullback where we're not violating any rules and we actually have all of the other rules, and then we're getting 5 to come up to 260.18 or 360.18 while having 3 on the underside of 260.18 or 160.18, that's going to indicate to me when I have my A, B, C wave forming, what I can do now is wait to see where my A goes. And then once that A level is continuing to make a move up, I can now take this Fibonacci retracement starting on this A wave, drag down my Fibonacci, and you can see, obviously this is a diagram, but I'm going to show examples of this on an actual chart so you can see how it works. You'll see price comes back up into 61.8. Now, if I can put this in conjunction with our other analysis that we did, where we're literally taking trend levels that are important, where we have our trend being tested, comes through. If we can match this up with layers of confluence and read our trends like this, we can now have potential swing points for short positions or long positions off of these levels, as well as being able to time these other specific areas, which once again, if we take our Fibonacci retracement from the beginning of this trend up to the high point here, price will oftentimes, after this ABC corrective wave, come down to once again our golden 61.8 level before either making a move to the upside or having some sort of consolidation and then continuing to move down. Before we cap this off with smart money concepts and indicators, I want to share with you section number 4, which is going to be general price action patterns. Most traders are not going to rely too heavily on just pattern trading. This is basically a good description of all of the key patterns that we are looking for as traders. And I think it's important when you're doing technical analysis to understand. So first we have what's called a double top or bottom. And this is where price is coming into an area, responding off of it twice, and then having a reversal over these areas and then a retest on that area. If we use this as confirmation and get our retest, this is looking like an area that we could have bullish activity. Second thing is called a bull flag. You have price action moving in a bullish direction, having a parallel drawing, which we went over before, having a retest, which is indicating a probable continuation continuation to the upside. Okay, next we have a bull pennant. Bull pennant is when we have price action leading into this pattern in a bullish direction or an up direction, and then we're having an equal angled, basically triangle forming where we have a break out of the high, a retest on the opposite side, which is indicating a probable continuation to the upside. An ascending wedge is something that is really helpful and useful when it comes to fifth waves and Elliott waves, but really when we're getting close to the tops of trends, these tend to happen. We have price action bullish into the pattern, and it creates this 1, 2, 3, 4, 5 wave pattern, breaks out of this wedge shaped pattern, tests the opposite side of it, indicating a potential reversal is likely. Same thing in the opposite direction for descending wedge. Triple top, same thing as double top that we saw over here, where we're getting 1, 2, 3 sequence of touch points, a break under that level and a retest, indicating probability of bearish direction. Okay, a bearish flag, same thing as a bull flag, starting with a bearish direction and an overall bearish trend, indicating bearish direction. Bear pennant, bearish price action into this equal-sided triangular pattern, testing the underside, continuing down. Okay, next pattern is something called a head and shoulders pattern. That's basically where you have price action pushing, creating a shoulder, coming up to a solid baseline, creating a lower level, which is giving you your head, coming back down to that equal area, creating another low but higher than the head, creating the opposite shoulder, and then retesting that neckline. Once price breaks out and retests it, that is a bullish indication as far as an inverse head and shoulders. And then for a regular head and shoulders, you can see patterns sort of developing like this, breaking that neckline and then continuing to move down. You can basically sit there with these patterns and go over charts to start to understand how this ties into trend development. And if you can pair these up with your other trend analysis, can actually be pretty helpful confluences. But I'm not using these as my main drivers to take trading positions by any means, but it can be used as a confluence. And realistically, I'm not using cup and handle patterns, but basically this is what I would call an ascending triangle where we have lows continuing to move up with a solid neckline. Once that neckline breaks and retests, that's oftentimes a massive area where price will continue to move up. So now let's get into section number 5, where I talk about some of the key indicators that I'm using when I'm doing my analysis as sort of like the final touch to get my analysis to where I need it to be. First thing that I want to go over is something that has to do with candlestick structure that is called a fair value gap. Now, these fair value gaps, I'm going to show you how important they are on day-to-day micro entries or just in general timing good areas on trends. But I first want to explain to you what they are. Something that we're calling a bullish fair value gap is basically a sequence of 3 bullish candles where we don't have the wicks of the first and the third candle overlapping, which is leaving us this space between called a fair value gap. Now, typically we want these to be actionable candles where you can see we're having a downtrend and then we have a big change in direction by an impactful candle that's going to leave behind one of these fair value gaps. What I'm mostly looking at for these fair value gaps is to see how price responds off of this center line, which is called the consequential encroachment level. So basically, if we see candles push up and then come back and retrace into this fair value gap, what I'm looking for is for the candle to make an attempt to cross it and then have a rejection and close above this consequential encroachment level. If we can have that, as you can see in this example, paired with all of this stuff that we're talking about, this is a critical, hypercritical level you can see orders filled into before having massive moves to the upside. Additionally, if we're looking at our trend analysis here, say for example 1, 2, 3, 4, 5, we have 1, 2, 3 bearish candles. This is leaving behind a bearish fair value gap this time. You can see price pushed up, tried to cross the consequential encroachment level, got rejected off of it. Okay, and that was the highest point that price went before making continuations to the downside. Okay, and what you'll notice is professional traders really aren't relying too much on indicators. It's more of an extra layer, either showing them something that they already know, making it easier to see it in real time, or basically, once again, as a confluence to add to the idea that they already have from on the chart. You want to keep your chart basically as simple and stripped back as possible so you can see really what's going on in the markets and be able to make decisions. But I think that there's 2 indicators that are really important to know across the board, regardless of how your trading style works. First is going to be volume. So you can see these bars here on the bottom of my chart. Now, what these bars are showing me is showing me 2 things: the level of market participation in terms of volume and whether or not that market participation over the period of time was overwhelmingly on the buy side or the sell side. And that's going to indicate whether we have green or red candles. And that's going to dictate whether the buyers and sellers were more strong and in what quantity over that period of time. You'll see as we got all of these green candles to the upside, this is where we got a big influx of volume and mostly buy side volume. But something important to remember is when volume dies, the price does not equally die. You need high levels of volume in order to push the market drastically in one direction or the other. A lot of people think that when the volume dies, the chart is just going to die. That's not how that works. You need market participation to move the direction, whether it's up or down. But basically, we can can look at this to understand market participation and to see which candles actually have a lot of participation behind them, regardless of how big the candle necessarily is. And it's basically going to show you the level of participation at those specific zones. Okay, the next indicator that I want to talk about is something called an RSI, which stands for Relative Strength Index. And there's two things that are really, really cool when it comes to RSIs. The first is going to be basically whenever we see areas where price is generally outside of this purple level, which is the 70 level and the bottom threshold is 30, this is indicating that price is typically overvalued. So you'll see at this exact point, this is where we got our overvalued on the RSI. Price comes back down. This is the area where price starts to be undervalued. Then it went over to reverse. You can see overvalued here, brought back down, overvalued up into here. Price continued to move down. Once again, there's no indicator that's going to be like a silver bullet where it's just like buy and sell at these levels. That's not how it works. There's banks and institutions that work full-time tweaking algorithmic trading strategies that are working on trying to outpace the market and find an edge. All I'm saying is that these indicators can actually help put you into really interesting, generally good positions to start to take trades on with this actual strategy. So the next cool thing about an RSI, this is a really actionable way of doing analysis where you can actually predict a ton of things in the market, and that's through something called a divergence. So this is the way a divergence works in an RSI. Okay, so let's compare these peaks and these peaks. And so you'll notice we have price here, which is lower. We have a high RSI. If you look over here, price is actually higher on the chart, but you'll see it's lower on the RSI. This is a divergence. So anytime you're seeing this disparity, this is oftentimes an even better indication that we have the full top in before a major reversal. By the way, if you want to add any of these indicators, you can click into your indicator section on TradingView. You can just search in RSI, or if you want all the indicators that I use, I'll show you how to add them to TradingView here in a second. You can follow me on Instagram, DM me the word tools, and I'll have it sent over to you. Okay, you can see another example of a divergence here. So lower price, higher RSI, higher price, lower RSI, divergence, sell off in the market. This is going to once again put you in those good areas to be able to play into swings in the market. You can see undervalued here. This is giving you basically the bottom before price continued to move in the opposite direction. So now that we've covered basically all the bases, I'm going to show you how I set everything up on my chart so you can add it just like me. And then we're going to use all of what we learned to do a piece of analysis so I can show you how I do this in application on a real chart. And then a few examples of me doing this in real life, making actual profit. So first off, this is the indicator stack that I have on my TradingView. You can see I have my change of character and break of structure levels with something called Smart Money Concepts from Lux Algo. You can just go into here, click on Smart Money Concepts from Lux Algo. The next thing I have is Lux Algo Fair Value Gap, which you can also search in your indicators, and you can see that's going to put automatic fair value gaps on my chart. I have my volume indicator, and that's basically most of what I'm using, with exception of a custom indicator. You can see it's producing these diamonds here and these circles here, which is showing me areas where I should continue to buy in, as well as areas of reversals I should be anticipating for that are following my other confluences that I should be using to take long positions. Okay, this is something that we use on the private side of our trading team. All right, so first thing I'm going to do, figure out where our new trend line has started. Okay, so I could draw my downtrend here, breaks out of this level, tests the opposite side of that trend, and continues making a move up. Now I have confirmation of this level that we have a break of structure. So what I'm going to do now is draw my new trend level along these lows. You can see I have my fair value gaps all in this trend level. You can see off of this area, and once again, having positive response off of that area could give us massive opportunities to the upside if we're using these in conjunction with other strategies. Okay, so now I have my general trend established on this low level. Now what I want to start doing is counting my waves. So I have my first 1, 2, 3, 4, up to 5, finding my factor of 1 here, clicking from the base up to the high, back down. Now I'm basically evaluating my waves. So we have pretty choppy price action here, pretty complex, 3 to 4, whether it's this wave here or this wave right here, simple. So we have alternation set. Either way, this has to be our 2 wave up to 3, which is longer than our 1 wave, which is confirming that this is our 3 to 4. So 3 is not the shortest wave. We have that checked off. Once I play around with this a little bit, we're getting a resistance and support level off of 161.8, 261.8 perfectly touching at the top of 5 with a good development of a wave 5, and then a sell-off, which is now coming back down to test those levels. So now what I can do, I can take my Fibonacci level from here to here, and you can see this 61.8 level is coming right into this fair value gap. So this is going to be a key area to be able to enter in on a position if I wanted to take this to the downside. On the private side of our trading team, we have all sorts of entry, exit criteria, but I'm just going to go over just a general idea for you. Then I can take my Fibonacci retracement from this entire overall trend up to my high, mark out where my 61.8 is, which is exactly at the high of 1 here. So I can look to start taking profit at that area. Now I'm starting to have my AB forming, hopefully with the C movement down to this area. Price makes its way up. You can see responds responds beautifully off of that consequential encroachment level, rejects off of it, which would open up opportunity number 1. You can see prices coming back down to retest this area. So now we have a push underneath this level, which is creating our change of character level. So now even this area on the retest of the trend is becoming an additional opportunity. You can see price comes up, reacts off of that underside, has a continuation down. Now it's a break of structure. See whether we entered on something like this or whether we entered up on our original position. You can see price comes down beautifully to 61.8 before making a move back up to the upside. So you can see there's a multitude of ways to find approaches to the market. Now, once you tie this into data-backed strategies, which is all of what we're doing on the private side of our trading team, you can understand why our students are getting funded accounts like crazy, getting payout certificates like crazy, having really, really good days, and are able to navigate the markets doing things the proper way. You can see this is not hindsight activity. I'm drawing out my Elliott wave, I'm finding my fair value gaps, I'm following my detailed trading strategy, and you can see $3,800 in profit. I'm trailing my position down, 4,600. It took a lot of time for me to get here, but my goal is to be able to give you this information from my experience, allow you to apply it to whatever style trading that you're doing to hopefully improve your performance and allow you to find opportunities and navigate the markets like a beast. If you're still here, like the video, subscribe if you want to know when I drop videos. Go in the description, follow me on Instagram and DM me the word tools. I'll send you over basically all the resources that I use for my trading that I can share with you guys. You can check out our private trading team right here if you're looking for full education and team to take your trading seriously. If you want help setting up your trading view from square one, I have a great video I'll put right here. But until next time, I'll see you all in the next one.